We begin then with our top story, China struggling to adjust to a new normal.
I do think the wow factor is coming off.
This is a big change in economic growth.
Naturally, it has to slow down.
It can buy growth for now.
It's still an issue of China's economy converting to a consumer economy.
China is losing its erstwhile momentum as a developing, catching up economy.
What you get from the National People's Congress is a government that is very keen on stabilizing the economy.
They are easing monetary policies, they are injecting liquidity, and this morning they are talking more about fiscal stimulus or tax cuts.
China, in a way, has to admit that growth can't remain at 6% forever and regulate the economy to focus on more consumer-driven demand rather than state stimulus.
Joining me around the table here in New York City, Mike Ryan, UBS Global Wealth Management America's Chief Investment Officer, Eric Liu, Vanda Securities Head of Research, and Bloomberg's Lisa Abramowicz with us as well. So, Lisa, is this all about struggling to adjust to what is seemingly a new normal for China, lower growth?
You know, it's interesting. A lot of people are saying this is a positive, that China is allowing itself to acknowledge slower growth and isn't trying to juice growth with bridges to nowhere, et cetera. But the question is, have they ratcheted down growth expectations enough? And, you know, is there sort of a Moore's law here in terms of how much leverage they're piling on? In other words, as they add more leverage, which they're going to have to do in order to do this stimulus, does it get that much more expensive, that much less helpful to the economy, and that much potentially riskier going forward?
Eric, do we just assume they hit 625 now? Bang on the money, right in the middle of the range.
I think the entire argument is misplaced. Look, I think there's the long-term structural issue of China slowing down, and that's been going on for the past decade, right? And the short-term issue that everyone's really worried about, which is trade, which is impacting a lot of the short-term numbers that you're seeing: PMI, the Caixin PMI, the Li Keqiang index. Those are the things that are driving markets. It's not the 10-year structural deceleration.
What do you think, Mike?
Look, I agree with Eric. I think what you're seeing here is just we are seeing a global growth slowdown, which has affected a lot of the economies around the world. But what's exacerbating this is some of the trade frictions between the U.S. and China. Let's not ignore this. This is probably the biggest issue on the table. I think what China is doing now is a threefold approach to this. One is monetary stimulus. Secondly, fiscal stimulus. And then lastly, some give and take on the trade front. So that's the three-pronged strategy of China.